Good morning, I'm Chris Beach, and welcome to Charting the Markets on IG Live. And of course, it being Thanksgiving week, we can expect markets to get steadily quieter into tomorrow's session. We do have, of course, Fed minutes tonight and then NVIDIA earnings as well after the bell. So a couple of major events still yet to come, with NVIDIA earnings probably carrying more weight and certainly more interest, I should think, for markets generally. It was another strong day for US markets yesterday. The Dow up 200 points. The Nikkei, as we'll see in a minute, nudging back to the highs we saw in June. So in the IG platform, some reports or some headlines this morning suggesting the Nikkei did briefly touch a 33-year high overnight. Not quite reflected on our end, but that's, I think, it's a closing high yesterday. But overall, a dollar continuing to weaken generally, as we expect, of course, the Fed minutes to reiterate the fact that no more rate hikes are really expected in the months to come. So it's not the busiest week in terms of news flow. It certainly isn't the busiest day in terms of news flow, really. We've gone up to a fairly quiet start. The OpenAI saga has subsided for the time being. Hasn't really affected markets too much, although Microsoft stock was up yesterday. And we do continue to keep an eye on UK government borrowing levels, as well as some weakness in US Treasury yields, which really continues to provide a good basis for that rally in stocks. Usually stock markets tend to do relatively well around Thanksgiving, but then weaken after that. So that might be something to expect, and really not surprising after the big gains we've had in equity markets from the very beginning of November. But let's start with indices and the Dow, currently trading on the futures at 35,129, and that's just roughly where we were yesterday, around the close, maybe about 20 points down from yesterday's close. But the crucial point for the Dow is that we've now moved above, as of yesterday, these August and September highs, around 35,000. This was where the index faltered during the course of the month and then started to head lower. You see that quite dramatic, of course, in the middle of September, how we were up at 35,000 just, and then immediately the index slumped quite dramatically, taking it down to that September low, and indeed moving lower into October. So the fact it's back at those highs and B closed above it yesterday is a very solid sign for the index, and sort of caps the rally for the time being from the very lows of October. We've now gained about 2,000, nearly 3,000 points, probably about 2,500 points from the lows at the end of October, with the next target now being that end of July high at 35,700, essentially. Beyond that, we have to zoom out again to get a look at where we go from here. That takes us on. From there, you've got 35,860, which is the early February 2022 high, and then you have the two levels to watch from there being 36,465, which was the January 22 high, and also the area in the early November where it faltered, and then the high, the record high. It's quite remarkable that we're once again talking about that for the Dow. The record highs for Dow right at the beginning of 2022, 36,954. So not suggesting we could reach it by the end of the year, but certainly the 2-year round trip would fit with beautiful symmetry. Really, we've spent, as ever, it takes more time to recover those gains than it does to lose them. So the Dow dropped in about 10 months down to 28,655. It's taken it over a year to get back to where it is now, and should probably, if it carries on towards January, take about maybe 14, 15 months to get back to there. So it applies really quite the usual so markets fall faster than they rise definitely applies here. No real sign of any short-term weakness. Back below 35,900 would, of course, maybe send a bit of a chill through the market. It wouldn't be surprising, I think it has to be said really here. You can base your bullish view on the price continuing to rise, but expect maybe some volatility in the shorter term. Just because you think it's going to keep rising doesn't mean you think it will keep rising in a straight line, because it essentially has done that over the past month, with a tiny bit of consolidation in the first week of November and then up again. But overall, for it to really dent the bullish view, we need to see it back below the 100 day at the least, and then below 34,000. So a lot of ground to be lost there to really change the view on this index. The buyers firmly in control on this one for the time being. Here we are for the Nikkei as well. Now this one, as I say, Reuters reporting that the Nikkei briefly hit a 33-year high. I think that's the closing level for that index overnight. Another very, very strong performance there. sorry, on Monday's session for the Nikkei. Then overnight it did drop back again, and we find ourselves just back below trendline resistance, very shallow trendline resistance, but trendline resistance nonetheless from those June highs. That intersected with the highs in September and produced another pullback. Not as dramatic as it was for the Dow, unsurprisingly, perhaps, with yen weakness doing a lot to prop up the Nikkei. So the fact that dollar yen has begun to weaken itself, i.e. the yen has begun to strengthen against the dollar, has put a bit of pressure on the Japanese stocks. But again, not surprisingly, after the gain of around 3,000 points from the end of October. Markets are a bit like humans in that respect. They do have to take a breather from time to time. So it would not be surprising to see consolidation around here, around 33,000, maybe even down 500 points more or so. Because I think it's worth noting that we rallied about 11, just almost 11.5% really. We're now down the grand total of 2% from yesterday's highs. So it's all within the same kind of bullish view. The fact we've broken above trendline resistance, as with the same with the Dow moving above those August and September highs, the same thing for the Nikkei here. We were moving above that yesterday, back below it in the short term. But I wouldn't really take that as a sign that it's immediately going to reverse course and head lower. Some people, a lot of traders tend to rush into this and argue, oh, it's failed to hold above those highs. That's a clear bearish signal. I expect it now to reverse and go back to where it was in October and November, right at the lows. Potentially, anything can happen, but it doesn't seem to be much to base a view on at this point in time. So additional gains really back to that 34,000 level from June. And then from there, we really would be new record highs for the listing, or indeed the highest levels for the Nikkei. Here I have to go into a monthly chart to get a sense of where we are. As you can see, that this is the key thing, because the level from 1990, 33,187, we are just above that once more. So the next big one to watch, and you really don't get much bigger than this, is that high from December of 1989, 38,950. So look at that. We said the Dow, it's taken us 2 years to get back to where we were at the end of 2021. But the Nikkei, it's taken us 25 years to get back to where we were in 1989. And what an impressive round trip, nonetheless. So the Nikkei looking very, very strong for the time being, helped by that yen weakness over the past month or so, with a little bit of weakness coming in now because of the strengthening of dollar yen and indeed the weakness of the US dollar. And then also looking at European markets, not a bad rebound for these either, after a very torrid time for the CAC, particularly since April. We hit that record, I think it was a record high for the CAC in April, then weakens all the way back down again, 6,800 down to these March lows. It is still very much at risk of a lower high, really, here. And here, then maybe the bearish case is a bit more compelling than it is for the Dow or the Nikkei. A reversal of the 200-day would be textbook technical analysis. The fact it's closed and held above this area around 71.70, which was support in early September, and then weakness in late September, early October, is notable. It just finds itself, unsurprisingly, consolidating at most for the time being around 200-day. Closed back below maybe 71.50, and would really sort of put the cat amongst the pigeons and suggest that we do have a lower high in there. Otherwise, further gains take us on towards 7,400. Dollar weakness continues to predominate across markets, and that's leading to some interesting moves in euro dollar, because as you can see here on the chart, we're now at 109.50, recouping again about half the losses suffered in July, August, and September on that dollar strengthening. So you can see that there, 109.50, perhaps a key level to watch for this one. That's the late August high. It rallied for 4 days and then began a big fresh leg lower. So that's well worth watching this. Close above there, and things start to look a bit better, really, for the currency pair after what's been a very impressive recovery. Started slowly, but gathered pace, doing very, very well over the past month. So maybe if the Fed minutes are taken as slightly more hawkish than people thought, then maybe you get some weakness here around the dollar. Remember, of course, Thanksgiving affects everything this week, not just indices and FX markets, but you really might feel it in FX markets with dollar liquidity disappearing. So be prepared for the potential for volatility around this. Further gains, nonetheless, take us on towards 110, 110.15 rather. And then we'll see whether it has the power to maintain this and continue to move upwards over the course of time towards those July highs. Now, I think it's important to remember that, as I said, markets fall faster than they rise. So they tend to fall in this dramatic way and they take much longer to clamber back. So you would perhaps not be surprised if over the course of time you get a more severe pullback here that nonetheless leaves the uptrend intact. There's a bit of a sort of curved trendline support, if I can put it that way, because it could always go back towards 107 and still not test this trendline support from the October low. So it's pulled away quite a bit from that. Does maybe leave it vulnerable in the short term to some resurgence in the US dollar. If we stay with the euro but move to the pound, taking a bit of a knock this morning, actually, the pound strengthening despite some mixed UK figures this morning, nothing too weighty. Very much a choppy direction of travel really for the pound against the euro against the dollar, sorry, the euro against the pound. But nonetheless, still just about holding on to its own uptrend here. Higher lows all the way through. At the beginning of the month, you had a higher low at 86.50, and the price is now clocked up just a higher high, just above 87.50. So the buyer's in charge in this one as well for the time being. No sign of that reversing in the short term. You might argue for the form of trendline support at least now coming in from those lows in August. Very much a rounded bottom here after this pullback from the February highs. As you saw in the end of October into the beginning of November, it did have that pullback, but it found support around the 50-day moving average. So if history repeats itself, maybe it drops back to 8,700, starts to rally once again. And then turning to the Aussie dollar, always a good indicator of risk appetite, still doing its best to claw its way higher as well. Really doing a lot of heavy lifting here to provide a more optimistic outlook for the currency pair. But it is just once again knocking on the door of the 200-day moving average, and that can cause at least a little bit of volatility or hesitancy, and that crucially is also around this 66 level, which was support in June, and there was also resistance in August. So at the moment we're looking at that as potential resistance. A close above it becomes support and will continue to bolster the bullish view. But if it say failed to close above that and then drop back below 65.50, maybe you can argue there's a lower high in place there as well, and we can see it go back down again. Definitely one to watch in coming days. And then turning to gold and oil prices. Once again, another good morning for gold, back at 1989, 1990. After its higher low last week, that's certainly still intact, and buying pressure continues to come into play. We could be on the cusp of a bullish MACD crossover in coming sessions, which again reinforces the bullish view. And you've got the moving averages moving higher, though. 50-day after its death cross at the end of September, you have to set dramatic points. It's the law. But if it goes back above the 200-day, that golden cross, that would solidify again the bullish view, or at least I think make you more inclined to take a bullish view at this point. Where if the 50 days above the 200-day, you can argue that that's perhaps more of a bullish view. You're trying to buy the dips rather than sell the rallies, vice versa. Unfortunately, of course, it doesn't always work, and lo and behold, that huge rally we had from the beginning of October could have turned into a lower high, didn't, and has really changed the view here. And now the buyer's firmly in charge once again. And maybe we might get a push finally back to those highs from May of this year, which would doubtless get a lot of people excited. Everyone loves it when gold goes back above 2,000, big round number. What's not to like? And we head back maybe in the direction of those May highs. Finally, crude oil. The volatile asset par excellence of the past month or so, what has been, of course, a volatile month. And here it could be doing what we would expect it to do, really. It's a very analyst thing to say it's probably due a pullback or a short-term reversal without leaving the overall trend, without damaging the overall trend too much. And here you've got very much a downtrend here from the September highs, but you would expect after the magnitude of that October drop to that November low, some kind of recovery. And that's exactly what we've got. We're back at the 200-day moving average, definitely one to keep an eye on. We couldn't hold above it last week. Can we do it this week? If then, perhaps it takes us on to $80, because that, interestingly, at the beginning of November was an area where buyers tried to mount some a defense and support the price. It didn't succeed, so this time it could be resistance again. Definitely one to watch, but maybe the short-term bounce continues, even though I think with the price below the 200-day and below the 50-day moving average, the short-term view tends towards the negative. So today's main events being those Fed minutes, 7 p.m. UK time, and expected really to reiterate the Fed's view that there's no more need for rate hikes for the time being because inflation is mostly under control, as that CPI reading and PPI reading last week tended to reinforce. Then Nvidia earnings after the bell tonight around 9 o'clock, which will put tech stocks in focus once again. The last of the really, really big names reporting, I think it's fair to say. So do watch out for that. Slightly more cautious opening expected on the Dow, down around 30 points from yesterday's very strong close after gaining 200 points in Monday's session. But that's it for me. Thank you for joining us, and we'll be back as normal tomorrow at 10:30.